Welcome to the Trader's Desk. It's the 27th of July 2025. Before we get started, this is not financial advice. This is purely for educational basis. Do read the disclaimer. Also, do read the copyright notice. Another week in financial markets where we just grind higher. The S&P 500 is making a new high. It's the same for the Nasdaq 100. It's been quite an easy ride up this week, although one can say that some of the days were not of the highest trading volumes, but that's quite normal for this time of the year. We've also gotten some very good earnings reports, so the market is just cruising higher. Not much along the way in terms of, fears of downgrades or GDP growth declining and so on. Moving on with the RSP, which is the equal weighted version of the S&P 500, a solid rally. So we're now at all-time highs, and that's a good news because it shows that the rally is broadening out to the rest of the economy. So we're not just looking at the Magnificent Seven or the top 10 companies in the S&P 500. So that bodes well. It reflects that the economy is probably a lot stronger across the board as people would have thought. And I think that's a good sign because it shows us that, you know, the rally is not dominated just by a few companies, and the fate of the stock market is not just in the hands of the top seven, top 10 companies. On the right, we've got the Magnificent Seven. So it had a smaller rally than the rest of the indices. That's a large part because Tesla has been doing its own thing in terms of, reporting and then a lot of volatility there. So if you ask me what Tesla stock trades on, I would probably say I don't know because it doesn't reflect the fundamentals of the business. It's a dream stock, so a lot of retail crowding, a lot of narratives, and nothing much to show in terms of actual fundamentals. A lot of talking about Tesla is not a car manufacturer, Tesla is a software stock, Tesla is, whatever. But at the end of the day, stock prices need to reflect fundamentals eventually. You cannot look out to the next 30 years for the fundamentals and then say today's stock price is on that basis. There's so much that can change between now and the next 2 years, for example. But anyway, it's not a stock I trade actively, so don't really care. Um, Moving on, the small cap index, not the biggest of rallies, so there's not been a lot of appetite for small caps because people can still find great quality in mid caps. I still think that's the next part of where the rally will be heading. So I think there's a bit of upside within small caps, especially if you are able to find the high quality companies. Then in terms of the momentum ETF, another high this week, so nothing much to note here. Moving on, the US 10-year yield, it fell a little bit on Friday, um, but it's still above the 200-day moving average. So this is kind of what's driving financial markets. And we kind of have two separate schools that are firmly grounded. You have one school that is worried about long-term inflation in the US economy. Um, a large part of that is to do with the US fiscal irresponsibility. So, the US government is not really focused on reining in deficit spending, and it's quite lax from that perspective, quite happy to keep that going. And of course, that doesn't bode well for people who are lending money to the US government because essentially the inflation is coming at a cost to them. Because remember, bond investors only get a coupon as a reward for lending money to the government, right? So if that coupon is being eaten away by inflation that is significantly higher than the target inflation set by the Fed, and if that happens over a 10-year term, That's quite significant. So essentially, you've given money to the U.S. government and gotten less than what you gave the government. You not only that you did not get any rewards, but it also chipped away at the real value of the money that you've given to the U.S. government. Then you've got the other school that believes that as the Fed cuts, all of these long-term yields will also head back down. I'm in the camp that is starting to think that if the Fed cuts, we might not see the long-term yield move, or we might start seeing a situation where the Fed can only impact the short-term yields, and the long-term yields stay firmly within the control of long-term investors, bond investors, that is. And that's an interesting situation because it's rarely happened in the past. And that would be predominantly because the long-term investors are worried about the inflation risk on a long-term basis. I think there's also, a lot of worries that the US government is borrowing money and then monetizing the debt through inflation. So that doesn't that doesn't paint a good picture. And all of this stems from the era where, the previous secretary, US Treasury Secretary, started borrowing more in the short-term market, which is not something that the US government would typically do. And that's a clear mechanism for monetizing debt. And this carries through to this administration too, which has kind of been vehemently against that practice. But the whole notion of the US government just taking bond investors for idiots and taking them for a ride is becoming a lot more pronounced in markets. So that's literally what's driving the long-term yields. And you'll see across the world, long-term yields have also been starting to head up because most of the developed nations are running deficits, and bond investors are not as stupid as they used to be. I think they've been taken for a ride for decades, and now they've kind of woken up. If we look on the right, we've got the Japanese yen, the Japanese 10-year yield. This basically hit the all-time high this week. It's not something we dismiss because Japan is still a massive economy. It's still a big part of capital flows. And as you would know, there is a big carry trade that's still, on. And any changes to these would significantly cause a risk of an unwind in this carry trade, right? Which essentially impacts the tech stocks and, a lot of the stocks that have been bought with USDs that eventually originated from Japan, right? Um, what I also wanted to discuss was that we have the Bank of Japan reporting on, I think, Wednesday. So keep an eye on this. The CPI reports lately in Japan have not been the highest. So inflation has kind of gone down a little bit, but it would be interesting to see what the Bank of Japan has to say, especially with the new US Japan trade deal and how they perceive inflation, what would be their monetary policy stance from here onwards. Um, if the long-term yields in Japan keep going up, then the incentive to buy Japanese yen increases, right? And if you think about it, if the Bank of Japan decides to increase interest rates, that causes people to want to buy Japanese yen and causes a rally in the Japanese yen, which comes at a detriment to the USD. And basically, anyone who's got the carry trade on is short Japanese yen, long USD. So if this carries on, or if the Bank of Japan gives further indication that they are still going to keep hiking and nothing's changed in their plan, um, I don't think that's going to be positive for the whole crowd that has this carry trade on. I mean, if we look at the Japanese yen versus the USD, I think it's somewhere around 146. 147 now. But you can see, right? It's kind of gone all the way down to, let's call it 140, and then it's recovered a little bit from there. So if we get back to 140 and around, I think that's going to cause a bit of an unwind in a lot of the tech stocks, which is where a lot of the carry trade money is invested. So keep an eye on this, not something that you should be losing sleep on, but just understand that these are the underpinnings of the financial market. At the moment, this is what is driving financial markets, and not a lot of people are paying attention to this because they are just looking at QQQ rallying every single week, and they're very happy with that. But this is basically the plumbing of the financial system. And this is what could be driving financial markets, let's say in a month or two. So we always need to be aware of the setup and make sure that when it happens, we're not getting caught. Instead, we've hedged or we are taking advantage of all these moves. So another week of a bit of short squeezes happening, although we've seen a lot of names that had these short squeezes last week or even at the start of the week, like Rocket, like Open Door, a few others. We've seen these names drop in value. So a lot of these short squeeze rallies are fizzling out. And as you've seen, it can be quite brutal, right? I mean, if we just look at some of these slides, that's probably the best way to understand it. So I'm going to put it on a daily basis. If you look at Rocket, for instance, right, it went from, let's call it 14 all the way to 17.45, and now it's back down to 15, right? So massive volatility for a stock that doesn't move that much. So if you had calls and let's say you participated in this trade, it only lasted for 4 days, right? One, two, three, I mean, not even the fourth. So what I'm trying to say is, let's say you bought calls and let's say you bought them at 13.5, right? And your strike was maybe 14 or 15. Um, to get this right, you need to take profits fairly quickly because these rallies are not lasting a long time. And if you have them on, the moment you get lucky, because this is what it is going to be, right? The moment you get lucky, just take profits or at least take half of it, then, maybe even restructure the second half or, at least get something out of it, right? Because otherwise you might just be a spectator to the whole thing, right? You're happy for 2 days, then the next 2 days just make you super sad, and now you're waiting in suspense, hoping that Monday brings something to you. And that's not what trading needs to be like. Trading needs to be predictable, consistent. Uh, if you look at Open Door, for example, went from nothing, right? Like less than a million, sorry, less than $1, and within a few days went to nearly $5, and then from there it just got bust, right? So again, if you had the trade on, you would need to take profits very quickly, right? Or just take profits along the way. Um, what matters is not that you participated. What matters is that you made money out of the trade, right? Another one, I was actually researching this like a week ago, and then it just happened on Monday. So on Friday, I was researching this. I think it was trading around 9.8. And then on Monday, it just caught fire. So again, like let's say on Friday I bought the calls and had a strike of $10 or $11. Um, I'd have to be able to take profits very quickly, right? Within the second day of the trade. Because if I let this run, I mean, I still probably make a lot of money if I have a strike of $10 when the stock was basically like this, right? Where volatility is almost nothing, and then it just explodes in the sky, right? It went all the way to $21. So think about it, right? 100% on one day. I think I was discussing this with Hans, right? Hans, you remember the discussion about whenever we're trading options, basically what we are saying is, I'm buying this option because I believe the implied volatility is wrong, and the actual realized volatility is going to be much higher than what's priced into the stock. So before the move, this is what the market maker has to make its, calculations on implied volatility, right? How much does this stock move per day, right? You could take like a whole year, the last 3 months, 6 months, whatever. It's never going to be this kind of volatility, right? But a clever trader would understand that the short squeeze play could happen here, right? And they set up something expecting that to happen. And if it really happens, I mean, the stock is moving 100% in a day. It's never happened. So it cannot be priced by the market makers, right? And that's why you'd make a fortune on that particular trade. So a lot of times as traders, what are we trying to do? We're trying to analyze stocks where the implied volatility is wrong. And basically we identify this feature within a specific timeline where we think there are catalysts that could move the stock a lot more than, its typical average true range, which is another way to say this is the volatility profile of the stock in usual times, right? Under usual circumstances. Is that clear to everybody? Hans, does that make sense?
Yes, there's a good discussion.
Tala, you were going to say something?
Yes, clear. I said clear. Yes.
Super. Let's move on. Um, so we'll look at the short squeeze play next. I'm not discouraged by some of these rallies fizzling out. So I still think there is a lot of alpha to be generated by looking at a couple of these ideas. Um, at the end of the day, I call these dirty trades because not they're not very fundamentally driven. But at the end of the day, a lot of fundamentally driven trades also don't work. So what counts is that you make money out of it, whether it's a dirty, clean, intellectual play or, whatever you call it. All that matters is you buy it at one, you sell it at five, right? That's all that we care about. Um, just give me 1 second. Okay, so let's look at the sector performances. Quite interestingly, healthcare has been on a tear after many, many weeks of being beaten down. So we'll discuss later in our presentation for the Discord members some opportunities within healthcare. And then we've got, it's been quite an interesting week in that a lot of the past leaders or outperformers in terms of sectors have not done the best this week. So, for instance, technology has been a consistent outperformer, communications as well, consumer discretionary. Some weeks, utilities have done extremely well too. And if we look at this week, it seems to me that there's been a bit of profit taking, or maybe even people waiting on the sidelines as you have major earnings coming, in the next few weeks. So not much to read from that perspective. It's not like, that's a turning point for these sectors. It's just understanding how market participants think and how they act, and not trying to extrapolate every single move that happens. Um, in terms of the outperformers, what I found quite interesting was the strength of industrials. And also, if you look at materials, these two have been doing very, very, very well. If you look at the monthly performance, so industrials have been up 7.8%, materials have been up 6.4%. So stellar month. And what's great within these segments is these would tend to be low PE or kind of low to mid PE type companies, right? Like 15 to 20 or even lower than 15 in many cases. And these are the cases, just to connect with my discussion previously. These are the segments where implied volatility could be priced much lower than what realized volatility would be, because there are real transformations that are happening within these sectors, especially with the manufacturing reshoring theme. And there's no way that market makers can price that in, right? Another good week for real estate as well. So it's slowly coming back, but I think it's still being driven a lot by long-term yields. And I wouldn't be surprised to see, that real estate is one of the underperformers next week. I mean, if you look at on a monthly basis, it's still grossly underperforming the S&P 500, right? So not much else to read in this. Energy is also doing fairly well, in spite of the crude oil probably not rising. It's kind of been moving lower. I think it's around $65 now. But I think even within energy, there are lots of opportunities, both for longs and shorts. So it's all about understanding, what's driving these markets and then finding the right vehicles to participate in those trends. Uh, Actually, that's what's great in this market. The dispersion is phenomenal because that allows you as a long and short trader to be able to find really high quality ideas on both ends. In terms of industries, what surprised me was the underperformance of regional banks. I think that's probably due to profit taking again. It's become a bit of a crowded trade now, not just by retail, but also by institutions, whereby it's widely expected that regulations are going to have a positive impact on a lot of these companies. So people are already positioning ahead of time. It doesn't mean that we would not go along this sector. I think there are still opportunities there. Um, but it's how you interpret the weekly move, right? Sometimes it means something, sometimes it doesn't. In this case, I think nothing to be scared about. It's probably just profit taking. Um, and at the same time, right, if the long-term yields are going to stay elevated, irrespective of whether the Fed cuts or not, then that means that the net interest margins of banks will tend to be quite healthy. Right. So looking at other sectors, what I also found was quite interesting was that software and internet, in line with tech stocks, they did not really outperform. I think again that's a lot of profit taking and also people waiting for actual earnings to surface. What surprised me was a bit of overly positive reaction within the home builders. So you know my views on the home builders, and I've covered some of the earnings with D.R. Horton, and I don't think I've covered Toll Brothers, but I've looked at the earnings. It's very similar trends in both. So my view is that this is being driven by sentiment and not really by fundamentals. So people are looking ahead and pricing in a few Fed cuts and hoping that these would actually cause the home building or even the housing sector to restart. Um, I think it's a bit too naive to think that this will happen. Although I do understand the way equity markets look at things, right? But if we look at a sector that's as big as the housing sector, uh, this is not something that just flips overnight, right? It's like a big value chain, physical. Um, a lot of it is like physical, right? Ordering of inventories, building houses, there are lagging factors. You cannot impact that cycle, so quickly. So, I mean, what I'm saying, actually, if I look at the earnings, is the fundamentals are getting weaker. And if we think about it in terms of costs are also going through the roof with copper, with steel, um, which happens to be a big part of the home builders' input costs, right? So if I look at the fundamentals and I look at the price action, I think I'm seeing a bit of dislocation here. So, maybe I'm wrong, or maybe eventually I'll be proven right. But what matters is, what are you going to do now? What are the trades that you put onto your portfolio? Or do you even participate in that segment? So at the moment, if you ask me, I'm still bearish on home building. But if you wanted to have, let's say, a few plays, I would probably recommend that you look at a different part of the housing value chain. So maybe look at something that's related to um, which company will benefit from an increased number of transactions or real estate transactions, like brokerages. Um, Home builders, I think, will suffer or will be challenged for a long time because they still have to deal with the inventory issues, and a lot of the input cost inflation, all of that will impact their earnings. And as we've seen with DR Hortons, right, there's not like a single bone within that earnings that I thought was positive. uh, it doesn't matter how the management paints the whole picture, but if you look at the numbers, we're seeing contraction across the board. So backlogs are declining, EPS declining. There's nothing that tells me that the future is bright. The building permits at an industry level are declining. Um, so I think it could be a moment of realization for the market eventually that they've gone ahead of themselves. But we'll see. Especially we have the Fed meeting this week, so I'm quite interested to see what would happen after the meeting, because I'm quite confident that Powell will stay hawkish, but then he might throw in something dovish that makes the whole market react differently. So I'm not expecting him to cut rates, but you can never tell how these things will go. Another sector that's been doing amazing on the month is clean energy. So that's a bit counterintuitive because the regulations should have actually um caused this whole sector to you know not do very well financially. So there's a mixed story there, a story of short squeezes, also a story of basically companies rushing to finish projects ahead of schedule because the regulations state that you will not benefit from the tax advantages for projects that are completed after, I think, 2027. So a lot of companies are rushing to finish these projects so they still benefit from the tax advantage. But either way, I think it's a sector that's already had its move. And if you still want to participate, I think there are some good companies there. You could even align it with a short squeeze and, try to be as imaginative as you can. Um, that's probably all I have to say for now. One thing to note also, so oil services was the outperformer on the week, and then oil and gas exploration and producers, amongst the weakest. So when we talk of dispersion, I think you're seeing it right in front of your eyes. On the month, the oil services are up nearly 11%. On the month, the oil and gas E&P are up 1.5%. So that's massive dispersion, right? Just to put it into perspective, so oil and gas E&P, they basically look for wells, they're drilling, they are producing oil, they're taking oil out of the ground. Whereas oil services are the guys who, let's say, will lend you drilling equipment, or they will do like seismic analysis for you. These would be guys like, BKG, HAL. If you're familiar with this sector, you would know these names. But at the end of the day, the whole point is, if you wanted to find dispersion, you're finding it brilliantly in this market. You would also recall my discussion in the Discord server whereby I said that the reaction within these two segments differ based on, the absolute level of the oil price. Because as the oil price goes lower, oil and gas E&P, they have an actual price at which they break even. So let's say if a company breaks even at $60 and then they are able to sell crude oil at 65, you know, it's still okay. But if the crude oil price goes to $50, then that company, its earnings will be impacted quite significantly. On the other hand, the oil services, they tend to work on the basis of contracts, right? So they are still impacted by the crude oil price, but you know, they are more related to the oil and gas E&P's capex. So basically, if these companies are planning to drill more, then the oil services will still get contracts and they will still get contracts at healthy rates. But if oil goes to, let's say, 45, the first thing that will happen is the oil and gas E&P would want to cut capex. And by definition, this would mean that the oil services segment will just crumble from there, right? Because the value of the contracts will go down, the rates will go down, the availability of these contracts would go down, and the equity markets will price that in. Go ahead, Tella. You've got a question?
So when you're talking about E&P and oil services, what's the thought around oil prices in the near future? Are
Um,
we seeing them to further go down from here?
I, my personal view is that if the economy is doing well, right, especially in the UK, in the US, and if you have China doing more stimulus, I'm more tempted to think of a world where the oil price is going to go up. But the other side is, Trump wants a lower oil price, so he has a bit of influence on this with asking Saudi Arabia, which is one of the biggest members of OPEC, to produce more and so on. So at this stage, I would lean towards saying I think the next move in oil is probably up, especially if I think about, the possibility of Middle East conflicts escalating. Um, and if you were to hold a gun to my head and say, okay, you've got oil in front of you, do you buy or short it? I'd probably buy it. Um, so that's my view at the moment. I do not see a world where, you have, let's say, the US economy firing on all cylinders, and then the oil price is just going lower. The other thing I probably want to show you would be this. Uh, so these are the drilled but uncompleted wells. I just want to show you a chart of this. And this is in the US, right? So look at the red line only. I don't think okay. Yeah, I mean, I can leave the blue line. It's fine. Look at the red line only. So these are basically the number of wells that have been drilled but are not completed. So if you think about it, these are the number of future wells that will come into production in the US. It's kind of at all-time lows, right? So we are not really seeing the supply picture growing from the US, right? If you remember, it's the US shale oil that actually changed the whole game with crude oil. And, from a supply perspective, I'm not seeing the US in a position to increase oil production much higher. What happens typically with shale oil wells is you run them for 12 months, 16 months, 24 months, then, you run out of oil, or, the quality of the oil is not as good as it used to be because you've depleted the well, and now it's no longer that economical to exploit that well. So you probably shut it down and look for a new well. It's basically in the hands of OPEC now to increase their oil supplies and oil production and supplies. And my view is, if you have a situation in the global economy where, the health of large economies are still fine, which is basically what everyone's telling us, then that doesn't lead to us believing that the crude oil price will stay that low, right? And I say that low because when we look at the crude oil price, we also need to factor that, we've been running inflation at significantly higher rates. So if we were to adjust this for inflation, it's not $65, it's like much lower, from the perspective of, an adjustment of for inflation. So all these factors kind of make me lean towards saying that we probably should see oil at a higher price. But things can be different. I'm not the best at predicting these things, but we'll see. We'll see how it goes. And if you wanted to get involved in this sector, I think this is one thing that you would need to figure out. Where is crude oil heading? Uh, I would be a bit more inclined to look at the natural gas sector because I see a lot more demand there, especially with the whole AI electricity demand. So I can see a world whereby in the next few months, natural gas goes higher because demand for it is increasing from an electricity production perspective. And then from that perspective, identify a couple of companies that benefit from a higher natural gas. Um, another another way to play this would be to say if the economy is still healthy, then the volumes of oil and natural gas that will be circulating around would still increase, right? And then you start looking at midstream companies, which is what I discussed just today in the Discord server. So you're basically then saying, I'm looking at a world where the oil price is not going to $30, nor is it going to $100. It's going to be trading sideways 65 to 70 to 75. And within that range, the volume of oil being moved around and stored is not going to be impacted negatively. And then you play through these equities. So, as you can see, there are different ways to play these depending on your view on the situation. Let's move on. So another interesting thing. So we've seen airlines um, underperform this week. So a large part of that is driven by underwhelming demand, especially international arrivals into the US. But if you look at the performance on a monthly basis, it's been one of the strongest industries. And a large part of that is because of the oil price falling, which also causes jet fuel price to come down. Uh, let's just do this quickly, and then I want to start our segment as soon as possible. So in terms of this week, so it looks like mid-cap growth comes back into focus to the detriment of small-cap growth. Large cap growth was also underwhelming, although on a monthly basis, right, small cap value is an outperformer, followed by mid cap growth, and then followed by large cap growth. So I think if you think about it, the market is still not necessarily sure in terms of where the next capital allocation will go. Um, I have a view that we'll see a bit of capital rotation into more quality slash value type companies. There's been a lot of frothy action, and typically what happens after you know huge momentum driven moves is that the market becomes a bit more rationalized and capital start discriminating a lot more, and they start flowing towards higher quality companies, higher quality segments. And of course, where we're standing now is we're looking at a possible regime change in terms of interest rates. So if the market believes that interest rate path would go lower from here onwards, then it would start moving towards the riskier segments like mid caps and small caps. So that's a bit of mixed price action that we've been seeing over the last few weeks, and it's predominantly, from these two fighting forces, right? Do you go higher quality or do you go down the quality spectrum because you would have a big macro tailwind? That's basically the question. Yeah. Nothing much to note in corporate bond yields. Another week of going significantly lower. So in corporate bonds, no one cares about risk. That's the translation. I wanted to highlight this to you as well. I think I've posted about this in the Discord server. So commodities, particularly industrial metals, have been on a tear, and it looks to me like it's going to head higher. So what does that mean for inflation? What does that mean for us? If we go into a world that's driven by a commodity bull market, what are the opportunities for us? How can we make money on that basis? There would be good long and short ideas from this theme. So, for example, you could go long a copper producer in the US or aluminum producer in the US, and then short, let's say, a company that depends on copper as one of its raw materials in anticipation that there will be a bit of margin compression from that perspective. So that's literally how you think about these things. And I think if you look at the world ahead, we're quite well poised to have a commodity bull market. We've been expecting this for the longest time, but I think if you look at the supply and demand picture, it seems to me that many of these metals, or even wider, broader commodities, have a leg to move up. At the same time, you've got Trump that's putting tariffs on things like steel, aluminum, and copper, uh, which basically increases the price of these commodities. So this is something to think about. Can you find good ideas from there? I doubt you cannot. But it's always important to bring these things in front of you, and then to trigger some thoughts so you're able to look for your ideas on your own. Yeah.